Welcome to ING's Think Aloud, where we try to make sense of the world in the most unbanky way we can. Today's episode is dedicated to my father, Michael Byrne, a classical pianist, teacher and engineer, a Renaissance man and the most selfless person I've ever known. Coming up today.
The fact that they're not willing to acknowledge we won at this point is not of much consequence in our planning and what we're able to do between now and January 20th.
President-elect Joe Biden says the Trump administration's refusal to concede the election will not affect the transition of power. But could this lack of cooperation be a harbinger of things to come? Unless Democrats can secure 2 Senate seats in Georgia in a January runoff, Republicans will retain control of the upper chamber, constraining Biden's ability to push through his economic agenda and the Democrats' proposed fiscal stimulus worth $3.4 trillion. The ongoing political division in Washington comes as millions of Americans remain out of work, incomes are being squeezed, and rising COVID-19 cases raise the spectre of new restrictions. I'm Rebecca Byrne, and today I'm joined by ING's chief international economist James Knightley in New York to discuss the outlook for the US economy with Biden at the helm. James, Trump has not yet conceded the election. It's kind of hard for Biden to work with the Republicans when they won't acknowledge that he's won. How is this going to impact the fiscal stimulus package? Will it be delayed? Will we have to wait until the new year when Biden is sworn in? What can we expect when he is?
Yeah, I mean, we've been talking about a fiscal package for 3 or 4 months now because, of course, the initial CARES package, which came in April, was astonishing. It was huge. It was a really good, well-targeted stimulus, which gave money to businesses. It supported incomes for households as well, and really lifted the economy and helped boost activity once we allowed the reopening to get underway. But there is an anxiety that a lot of people are now seeing their unemployment benefits expire. There's a bit of an income squeeze going on, and we've got more uncertainty with rising COVID. So there is a strong case for more fiscal stimulus. But as you say, the election is still up in the air to some extent. Although all the media has declared Biden victorious, Trump is trying to explore all avenues to see if he can somehow still retain the presidency. And this is leading to relations on Capitol Hill really not being very conducive to getting another fiscal deal. The animosity that we're seeing suggests that there's very little prospect of anything meaningful until perhaps indeed Joe Biden is sworn in. Where I'm worried though is that the US is showing an alarming spike in COVID cases, similar to what we have seen in Europe. And if we see this spike continue, hospitalization rates are already moving higher. There is that real sense that we could see containment measures kick in once more, possibly to the same extent as in Europe, with retail and bars and restaurants all severely impacted by new measures. And that's going to be undoubtedly economically damaging. And if you haven't got the support network in there to help businesses, to help consumers, that does create a very worrying backdrop for economic activity. So yes, I am increasingly nervous that this tense electoral backdrop is not conducive to getting the support that the economy is likely to need. And I do fear for where we could be heading over the next couple of months.
Well, under Trump, there did seem to be a slightly greater tolerance to let the virus run. Daily infections are surging. But of course, Trump's approach meant that the economy held up certainly better than in Europe. Could Biden's approach to the pandemic have a more detrimental impact on the economy? Could he enforce stricter measures and more social distancing?
Well, I mean, Joe Biden has advocated strongly the case of masks and following the science, whereas Donald Trump has perhaps suggested that we need to be more focused on the economic backdrop. So there is that sort of slight difference in how their attitudes are towards the virus. But of course, Joe Biden's not going to be president until January 20th, assuming everything continues, and the whole electoral college system works out. So he's not really got any influence or any say over the situation. So I sense, in general, that it's the state governors that decide the containment measures, and the political backdrop that we've got right now, where you have got this animosity, it's making it very tricky because in New York, we have started to see some containment measures, but we've got to remember the cases are actually now higher than they were at the peak in March and April. yet we're not seeing anywhere near the same containment measures. So I sense that politics is playing a role as well. A lot of the Democrat governors are not going to want to politicize this too much because of the tense backdrop. And Trump, you can quite easily imagine him saying, you're putting the economy at risk. And this difficult backdrop suggests to me there is a growing threat that this COVID spike is allowed to run. And I sense also with Thanksgiving coming up at the end of this month, politicians are going to be very reluctant to try and stop people going out and visiting friends and family over Thanksgiving. So I am getting more and more of the view that we are going to see this COVID spike really accelerate, and that perhaps will necessitate more aggressive lockdowns, possibly in December. So I think there will be economic consequences, but they will be coming somewhat later than what we're experiencing in Europe.
Right. There's a very good chance next year that Congress will be split, Republicans controlling the Senate, Democrats in charge of the House. How much will that constrain Biden's agenda? Markets seem to be kind of happy about it.
Yeah, Joe Biden and Donald Trump, you couldn't get two more different candidates. Donald Trump is looking for low taxes, lower regulation, America first, stricter on immigration, etc. Whereas Joe Biden is looking to raise taxes on corporates and wealthy households. He's looking at more regulation for key industries such as financial services, big tech, healthcare. He's a much more internationalist than Donald Trump is as well. So you couldn't get a starker difference, really. Now, where Joe Biden could be constrained is if he doesn't, as you say, win the Senate. And that's why we're looking at those two Georgia runoff elections that's going to be happening on January 5th. If the Democrats can overturn the Republican majorities there, then that gives Biden free rein to really push on with that sort of agenda. But if he doesn't get both of those, or the Democrats don't win both of those, then the Republicans maintain a majority in the Senate. And that would mean that he would need, or Joe Biden's and the Democrats would need, the support of one or more Republicans to get their policies through. So that inevitably means compromise. It means dilution of some of those plans. And the market is of the mindset that therefore means that we're probably going to see a less aggressive fiscal stimulus. It doesn't mean we're not going to get any stimulus. I think we still will get a substantial one. But it also diminishes the chances that we will see the tax hikes or the scale of the tax hikes that Joe Biden has discussed. So that, for the markets, is sort of a positive backdrop because, we're still getting a fiscal stimulus, but we're not going to get the aggressive taxes and we're perhaps not going to get as much regulation as we had been fearing under a Joe Biden Democrat clean sweep. So I think that's where we stand right now.
But one area that Biden would have more control over is trade policy. He doesn't need the support from Congress to review tariffs and things like that. So is that something you would expect to see? Would that help lift the US economy?
Yeah, I mean, Joe Biden recognizes, and he's very keen to say, look, we need to bring American jobs back. The whole idea of outsourcing has been bad news, and there are trade issues. There is a perception of unfairness. But he also recognizes that tariffs are not necessarily the best way of doing this because it's not the Chinese or the Europeans that pay the tariffs. It's American consumers and American businesses that pay the tariffs that Donald Trump has levied on imported goods. So he senses that is not necessarily a good backdrop. So he wants to negotiate and look at trade deals. But I think there's a subtle shift here in that he is also looking to ensure that labour conditions are brought into trade deals, which Donald Trump wasn't. So we're talking about general labour conditions, the pay rates, etc., the environmental standards as well. Those are going to be much more important. But also, I think when we've been looking at trade, we've been focusing very much on US versus China. I think an interesting dynamic under Joe Biden would be that he's much more likely to work with allies, such as Europe. And that's been the criticism of Donald Trump's trade war, if you like, with China, in that it hasn't been as effective as it would have been if Europe and US had been working together. Because if you get those two big trading blocs basically standing side by side, versus China, you're more likely to get the concessions that both Europe and America wants. And I think that could be a very interesting shift that we see over the next 4 years.
Right. We've only got a few weeks left in 2020. You've talked about this a little bit already, but what's the outlook for the US economy between now and when Biden takes office? I know you mentioned Thanksgiving potentially being a super spreader event. What can we expect in the fourth quarter and the first quarter of next year?
Yeah, I mean, well, the fourth quarter started pretty strongly in October, but I am worried, as you say, about what we've got coming up over the next few weeks, because I mentioned already that we've got this squeeze on incomes. Unemployment benefits are coming to an end. In the US, the state unemployment benefits typically last 26 weeks or 6 months. Now, of course, one was 6 months ago. Well, it was the height of the crisis when people were being laid off. So those people who have failed to get work have seen their incomes really be cut back. Moreover, the Federal Reserve had introduced this $600 per week federal unemployment benefit boost. Well, that's been tapered back to $300. So there's a big income squeeze. At the same time, the COVID cases is moving at an alarming speed and in an alarming direction. And I think we have to take on board the real likelihood now that we will see an increase in the containment measures, and that could well involve, the closing of bars, restaurants, and parts of retail. And that's undoubtedly going to have an economic impact. We're seeing it already in Europe, and I would sense that we could well see actual contraction in economic output in December and into January. Because yes, we've got there's this optimism about a vaccine, but there's a big window we've got until that inoculation program actually comes into reality. And I think that there is going to be the need for containment. I therefore do sense that we're probably going to get a negative period for economic growth, and that could translate into a negative first quarter GDP number. So I am sensing some real economic threats coming through from COVID once more. And that's also, unfortunately, going to mean job losses too. So financial markets right now are riding a crest of a wave, looking pretty upbeat. But I think there will be a growing sense of caution creeping into markets over the next few weeks.
What about 2021, though? Are things likely to get better as the year progresses? As you mentioned, we've had some pretty encouraging news about a vaccine this week.
Yeah, while I am more pessimistic than the general market view on the US economy over the next 2-3 months, I am actually more optimistic than the consensus is for the rest of next year. And that's largely down to, I think, once we do get a vaccine coming through, and there's every sign that is looking pretty good, a strong inoculation rollout program, that can start to allow a real reopening of the economy pretty early on, I would imagine, through, say, the second quarter of next year. And that can allow a lot of pent-up demand. Because in the US, what's been really holding back the consumer sector is actually higher income households, because they spend much more of their income on experiences, on going out to restaurants, to bars, to theatres, to cinemas, going on travel, holidays, etc. And if we can get that back, there's a huge amount of pent-up demand there. Coupled with the optimism that a vaccine brings, the relief that brings, people are much more inclined to return to normal behaviour. But also, I still am very optimistic. Even if we get a split Congress with the Republicans retaining control of the Senate, I still think we're going to get a very substantial fiscal stimulus of the order of in excess of $1 trillion, or more than 5 percentage points of GDP. So that's just more fuel for the fire of the recovery. So, as I say, very, very upbeat. I think big fiscal stimulus, pent-up demand, optimism returning, and with interest rates remaining at ultra low levels, that for me is the recipe for a boom-like scenario, really, for the second half of next year.
But could that also bring a Fed rate hike back into focus? The Fed is looking right now at 2024 as the year when rates could go up. But could that date be brought forward if we do indeed get a much stronger economy next year?
Very much so. I think that could be a very interesting theme, because, as you say, at the moment, the Federal Reserve has given us an indication that only 4 of their committee out of 17 are actually considering an interest rate rise before the end of 2023 is even remotely possible. But if we get those sorts of economic recovery coming through, I think that could shift those expectations forward. But also, I think inflation, is very benign, very, very weak right now. But we've got to remember there's been a lot of supply cut from the US economy. Think airlines. The number of aircraft and flight schedules has really been hacked back. Car hire. Again, these firms have not been investing in their fleets. We've already got some shortages coming through. Hotel capacity as well. Restaurants and bars that have gone out of business. Entertainment venues, cinemas that have gone out of business. Theatres that are gone. These factors that are likely to see big experiences or big recoveries in demand, they've been dramatically cut back. So you've got to imagine that there could be, real price hikes coming through in some of these areas. Also, the US housing market is booming right now because of record low mortgage rates. That is going to start to feed through into shelter components within inflation. And in the US, shelter is about 30% of the inflation basket. So I get a sense that actually those inflation expectations could really push higher. And in an environment of strong demand, you've got to think that the risks are perhaps skewed or more likely skewed to the Federal Reserve bringing forward expectations of interest rate hikes rather than pushing them further back. And that, I think, could be a key theme for financial markets next year, with upward pressure on government borrowing costs as a result.
Okay, James Knightley, ING's Chief International Economist in New York. Thanks very much.
Pleasure. Thank you.
This podcast has been prepared by ING solely for information purposes, irrespective of a particular user's means, financial situation, or investment objective. The information does not constitute investment recommendation, and nor is it investment, legal, or tax advice, or an offer or solicitation to purchase or sell any financial instrument. Read more at think.ing.com/content-disclaimer.